For more stock news updates, remember to press the like button and subscribe. With that being said, let's get straight into the video. Today we are analyzing two contrasting perspectives on SoFi Technologies. One financial expert advocates buying the stock, while another recommends selling it. By examining both arguments, investors can better evaluate the bullish and bearish sides before making a decision. By carefully examining these opposing articles, investors can gain a comprehensive understanding of the factors influencing the company's performance and valuation. This balanced analysis will help determine whether the stock aligns with their investment strategies and risk tolerance. The company has delivered outstanding performance in the year-to-date period, with its stock price increasing by an impressive 56.8%. This remarkable growth far exceeds the 23.5% gain posted by the industry average and the 27.1% rally seen in the Zacks Standard and Poor's 500 Composite Index. These results reflect the company's ability to outperform broader market trends, showcasing its resilience and competitive edge in the financial technology sector. This performance gap underscores the company's ability to carve out a leadership position in a highly competitive industry. Furthermore, as of the most recent trading session, the company's stock closed at $15.60, just shy of its 52-week high of $15.75. Trading above its 50-day moving average, the company exhibits strong momentum, suggesting continued investor confidence. This surge in the company's stock price is tied to its ability to innovate and offer products that cater to evolving consumer needs. A closer look at its third quarter 2024 performance reveals that the total number of products offered reached 13.7 million, marking a substantial year-over-year increase of 31% and a sequential growth of 7%. Transitioning from product numbers to membership growth, the company added over 756,000 new members in the same quarter, bringing its total membership count to 9.4 million. This represents an impressive 35% increase compared to the previous year and a nearly 7% rise from the prior quarter, further illustrating the company's ability to attract and retain customers in a competitive landscape. Shifting focus to its core lending segment, the company experienced a 19% year-over-year rise in lending products during the third quarter of 2024. This growth is driven by sustained demand for personal loans and notable increases in student and home loans. In fact, the company's loan origination volume rose by over 23% during the quarter compared to the same period last year, demonstrating robust operational performance in its core business areas. Beyond lending, the company's financial services division also made significant strides, with the total number of financial services products reaching 11.8 million, a year-over-year increase of 33%. This diversified growth across its business lines signals a strong foundation for sustainable expansion. The company's smallest yet strategically important technology platform segment also contributed to its success. Although this division generates the lowest proportion of revenue, it reported a 14% year-over-year increase in revenue during the third quarter of 2024, coupled with growth in the lending and financial services segments. This highlights the company's ability to leverage multiple revenue streams effectively. Importantly, the company's holistic approach of becoming a one-stop shop for its members positions it well for long-term profitability and market leadership. The company's management team plays a pivotal role in driving innovation and ensuring that the company consistently enhances its value proposition. By focusing on cross-selling opportunities and creating a seamless ecosystem for its members, the company is not only deepening customer loyalty, but also improving operational efficiency. These efforts are supported by strong valuation metrics. For instance, the company's forward price-to-earnings ratio currently stands at 57.48 times, significantly higher than the industry average of 16.77 times. While this may indicate a premium valuation, it also reflects the market's belief in the company's growth potential. Analysts project that the company's revenue will grow by 21.9% in 2024 and by 18.7% in 2025, further justifying its premium valuation. While the company's growth trajectory is undeniably impressive, not all analysts are convinced that its stock is a good buy. Critics point to its extremely high valuation as a significant concern. The company's non-generally accepted accounting principles price-to-earnings ratio for the trailing 12 months stands at 114.4 times, an astonishing 733% higher than the sector median of 13.7 times. Looking forward, the company's forward price-to-earnings ratio of 134.6 times is nearly 900% above the sector median. These metrics suggest that investors are paying a hefty premium for future growth, which introduces substantial execution risk. Furthermore, the company's valuation metrics on a generally accepted accounting principles basis tell a similar story. Its trailing 12-month price-to-earnings ratio is 132.5 times. Such elevated figures imply that the company must consistently deliver exceptional growth to meet investor expectations. This high level of growth expectation leaves little room for error. Even minor setbacks in execution or macroeconomic headwinds could significantly impact the stock's valuation and performance. Another factor contributing to a bearish sentiment is the company's lack of dividends. Unlike many of its competitors in the financial sector that offer dividends as a return to shareholders, the company reinvests all its earnings back into the business. While this strategy supports long-term growth, it makes the stock less attractive to income-focused investors. Additionally, the price-to-earnings-to-growth ratio of 1.99 is considerably above the sector average of 1.45, making the stock appear even more expensive relative to its peers. On a macroeconomic level, any deviation from the expected decrease in interest rates in 2025 could dampen the company's growth outlook. Moreover, the company's loan portfolio quality is showing early signs of stress. In the third quarter of 2023, loans delinquent for 90 days or more increased significantly, and loan charge-offs surged five-fold compared to the previous year. These trends highlight potential vulnerabilities in the company's financial health, particularly if consumer debt levels continue to rise. Despite these challenges, analysts acknowledge the company's impressive earnings growth projections. For instance, earnings per share are expected to rise to 28 cents in 2025, representing a growth rate of over 100%. However, even these optimistic projections do little to alleviate concerns about the company's high valuation and the risks associated with its current price levels. In summary, the company presents a complex investment opportunity with compelling growth potential and notable risks. On the bullish side, the company's innovative products, strong member growth, and diversified revenue streams highlight its ability to adapt and thrive in a competitive market. Its strategic initiatives to become a one-stop shop for financial services are promising and align with its long-term vision for shareholder value. On the bearish side, the company's valuation metrics raise significant concerns as the premium investors are paying for future growth leaves little margin for error. Combined with potential macroeconomic headwinds, signs of weakening loan portfolio quality, and the absence of dividends, these factors create a challenging risk-reward dynamic. Investors should weigh these opposing viewpoints carefully and consider their own risk tolerance and financial goals before making a decision. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.